Hello everyone, before I go into the usual details, please spare me 10 seconds. Today, aka 18 December, marks the first year of my YouTube sharing journey. My first YouTube video was posted on the same date last year. And despite still being a small channel, I am very grateful and appreciative of all the subscribers and viewers of this channel. You guys are the ones who keep me going. So once again, a big thank you. Alright, that's all. Let's get down to business. The stock market experienced a heavy sell-off last week in the wake of a hawkish Fed outlook and a potential global recession in 2023. Both S&P 500 and Nasdaq closed below the 50 moving average, and things are looking really bearish right now. But does this mean we will not have a center rally this year? Well, I will share my views on this question in this video, and also what to look out for on the technical charts leading up to the year end. Last week, we saw several mega cap stocks sliding down the hill, with Tesla and Apple leading the way. And you know what they say? When Apple goes, the market goes. As a result, both S&P 500 and Nasdaq ended the week with sharp losses. Just S&P 500 alone, the stock market has shed more than $1 trillion in total market value. Investors must be wondering what exactly happened, especially when Fed's Powell announced a 50 basis points rate hike, which is in line with the market expectation. Well, the reasons are simple. First, the benchmark interest rate has been raised to the highest level since 2007. Second, the Fed sees the interest to reach or peak at 5.1% in 2023, higher than what they had forecasted in September this year. Lastly, our dear friend Powell still sounds hawkish as ever, despite a cooling inflation number. Okay, we are 2 weeks away from the end of 2022, and it seems like the prospect of a traditional year-end rally has dimmed. At the moment, there are several headwinds that don't seem to be going away just yet. For example, the Fed's monetary policy, a potential higher unemployment rate as a result of the layoffs by several big tech firms, slower corporate growth, and all this could lead to a gloomy recession. So the key question right now is, have all this been priced in with the latest sell-off? Anyway, on a positive note, entering 2023, as the above headwinds gradually get digested and priced in, I think the market will then react positively to the potential tailwinds, such as a weaker US dollar, easing of supply chains with China reopening its economy, and of course a potential Fed pivot next year. Alright, let's now have a look at the technical charts, starting things off with SPY again. If you could recall, last week I shared that there were two bearish signs on the daily chart. One is a mini head and shoulder pattern, and the other is a MACD crossing down above the baseline. And here we have it, SPY dropped from 393 to 383. What actually amazed me was that at one point, SPY went all the way up to 408 when CPI data came out below expectation. But I guess at the end of the day, technical doesn't lie, at least for most of the occasions. And SPY declined from 408 to 383. That's 25 points drop, about 6% in the space of 3 or 4 trading days? Anyway, a gentle reminder that the stock doesn't go down in a straight line. So even if the head and shoulder and MACD bearish cross plays out well, there should still be some rallies here and there. And I am of the view that it is about time we have one. Why so? Let's have a look at the chart. Firstly, there is a gap at 379 to 381 waiting to be filled. Then below that, there is a Fibonacci support level at around 377. This area, I would call it a demand zone where buyers should step in. So if SPY goes down to fill the gap and further down to hit 377 support level, it should bring RSI to an oversold area. And that is when we could have a little bounce. To add on, SPY is currently touching the tip of the Ichimoku cloud, which forms another support. Finally, the last 4 days of sell-off has put SPY below the bottom end of the Bollinger Band. Just to share, usually when the stock hit the bottom of the Bollinger Band, it should eventually bounce up. But do note that this is not a strong indicator, as sometimes the stock can hug the lower band for a while. With that being said, it still adds to the probability of a little relief rally. So you get that. Gap fill, Fibonacci retracement support level, demand zone, potential oversold RSI, Ichimoku cloud support, and the Bollinger Band. When you add this up, we could possibly have a little bounce up. But okay, I don't have a crystal ball and I am not an expert. I mean, even an expert can get things wrong. So if let's say I am wrong, watch out for 370 as the last line of defense. If that level breaks, we could slide to 355. And mind you, 370 to 355 is a big 15 points drop. And at 355, I think bears can smell blood as they wait at the level of 52-week low, which is 346. Moving on to Apple, this week's chart is relatively easy to read. First of all, Apple has finally broken out of the triangle wedge pattern that I have mentioned previously, and it's looking bearish now. I have also shared on Mumu and in my last video that we have two support levels below, 138 and 134, where the former is a weak one and the latter 134 is critical. This 134 level will determine whether we can have a bounce to 140-ish or do we slide down to 120's range. And guess what? Apple is currently sitting just nicely at this key level of 134. Is this a coincidence or market manipulation? Anyway, if 134 continues to hold and Apple bounces from here, we could potentially have a double or even triple bottom pattern, which is a bullish sign. So how do we get a confirmation? Keep an eye on 138 to 139. If Apple goes above this supply zone and the daily chart prints about 2 or 3 green candles, to me that's the signal or confirmation of a double or triple bottom bounce. But then again, disclaimer, nothing is 100%. Do note that heavy resistance should come around 145. On the downside, I have to zoom out of the chart. Check it out, below 134, it seems like the next consolidation zone is around 118 to the current level 134. So in short, Apple needs to stay and break away from 134 soon. Otherwise, don't be surprised if we slide to 120's range or even retest 118. And to share with everyone, I actually dipped my toes in at 135 and 138 last week as I thought this area formed some good support. But then I didn't go on an aggressive buying mode so that in case I am wrong, I can pick up more shares at 120's range. Again, this is not a financial advice. To add on, I sold a put contract on Apple with a strike price of 125 as I thought that is a decent price to increase my portfolio allocation for Apple shares. But of course, if the market continues its massive sell-off, I may just roll my option to a lower strike price. On the other hand, if Apple doesn't fall to 125 on 20 January 2023, I will get to keep the premium of $165, which is 200-ish Sing dollars. Not a big sum, but decent enough to buy some coffee for myself. Okay, let's have a look at Tesla. What a week it had. It experienced one of the worst declines since the company went public back in 2010. The share is down by more than 60% from its peak in November 2021, marking the stock's largest drawdown since its market debut. A very quick recap, last week I shared that the Bollinger Band is getting tighter, which means a huge movement will likely happen. It's either we go to 150's range or we hit 200. There is no in between. To add on, I also shared a potential bearish MACD cross in my last video. Then on last Tuesday, I posted on Mumu that MACD has confirmed its bearish cross. Since then, Tesla dropped from 170-ish to 150. Alright, to be very honest with you, I didn't expect such a huge drop last week. But I guess the saving grace was that it was Elon who was selling and not institutions dumping the shares. Okay, so what's next? When I zoom out the chart, you will realize that Tesla is entering this consolidation zone between 120 and 155. Interestingly, there is a gap at 137 to 144. At the moment, Tesla is sitting dangerously at the psychological support level of 150. To me, it needs to break out of 150 to 155 zone as soon as possible, otherwise we could go down to fill the gap. On the upside, not sure if you recall, when Tesla was falling, I shared that once 170's range breaks, we could slide to 150's range. So now it's almost the same scenario. If Tesla can reclaim 155 convincingly with a few green candles, don't be surprised if it flies to 170's or even 180's range. And that's about 20 to 30 points upside. So if you are shorting Tesla, do watch out for these key levels. Next, moving to Tesla's option. Last Friday, I managed to close another put contract with profits at a close shave again. Tesla was being pushed from 170's to 150's range, and my strike price was 150. So I decided not to take any risk of allowing it to expire and pray that Tesla can stay above 150. Therefore, I made the decision to close the position. On the very same day, I sold a put contract with a strike price of 120 with expiration date on 20 January 2023. Reason being, the stock has been very beaten down for the last 2 weeks, and as shared, Elon contributed to part of the decline. Therefore, I am expecting some form of rebound. However, I don't know when, but at least this trade gives me 35 days to have the rebound. Anyway, please do not follow my trade blindly, as I have plans to save the trade if it goes against me. Meanwhile, let's see how this turns out. Alright, this week I decided to add in Nvidia into this video as I spotted something interesting. There is a shooting star candlestick forming on the weekly chart which indicates a potential price top and reversal. And guess what? The way it was formed, it's so textbook. So based on textbook definition, the shooting star candlestick is the most effective when it forms at least 3 or more consecutive rising candles with higher highs. And there you have it on the chart. So now, how to look for confirmation? Well, the next candle's high must go below the high of the shooting star, which is 187.9, and then it should proceed to close below the closing of the shooting star, which is 164.1. On the daily chart, MACD just had a bearish cross last Thursday, and the next support on the downside is at around 147. That's close to 20 points downside from the current level. But of course, the market can move in either way, and let's say the bearish thesis doesn't play out, it's important to set stop loss. Resistance on the upside is 173, where the 200 moving average is. It needs to print 2 or 3 green candles above it to be bullish, which could then bring us to 190's range. Okay, so here's the question, will we have center rally this year? To me, I feel the market can swing either way they want, and we as retail investors can never predict and get it right all the time. Okay, I know you probably hope to get more out of this video. All I can say is I'm not sure about the future. I don't even know what I'm going to eat tomorrow, let alone what's gonna happen to the stock market from now till the end of the year. The only thing that's clear and I am sure right now is that the market is not acting well at the moment. For the stock market to reverse the current downward trend and for us to have a center rally, S&P500 and Nasdaq need to reclaim both the 50 moving average and 200 moving average, which to me is an uphill task. Yes, we could have a bounce this week, but I would think that's purely a so-called technical or oversold rebound, which usually happens after the market is severely oversold. For seasoned technical traders, feel free to play or trade this bounce, be it riding the relief rally up, which is about time, or shorting the rip when it bounces up. But just some quick words of advice, the final trading days of the year can be quite wild in terms of volatility due to lesser liquidity. Anyway, with this, I hope you get my stand now. The probability of a center rally is not high. If anything, it will likely be a mini relief rally. My view may change if the key moving averages can be reclaimed as quickly as possible. The action in the stock market in the upcoming week should give us more clues and answers. Alright, hope you have learned something again from my video. Would appreciate any form of comments below. Please also help to hit the like and subscribe buttons if you haven't. Thank you.